isn't the first time that the RBI has flagged off the need for the government to deregulate fuel prices. Would you say you're a little disappointed at the pace at which the government's moving on this?
I wouldn't say disappointed. That would be the wrong word to use. Having worked in the government, especially after having been finance secretary, I can appreciate, I can sympathize with the concerns and the compulsions of the government. But we believe that an adjustment on the fiscal front is necessary for monetary policy to have an impact. An adjustment on the fiscal front is necessary for the monetary policy and fiscal policy together to have an anti-inflationary impact. Admittedly, if the government adjusts the administered prices, there would be an inflationary impact in the short term. But that would get adjusted, and that certainly would be better than the government absorbing this in the fisc, because that will be inflationary too, and it will also be inefficient. So there is a strong case for adjustment of administered prices, indeed for adjustment of all subsidies. I believe that will be more efficient for the economy.
Sure. But even if you were to go by the assumption that crude oil will average a price of about $110 a barrel in 2011, or rather in the current financial year, a number of analysts and economists we speak to say that the current account deficit in that case is going to come in at roughly 4%. How much of a concern would that be to you?
Well, I cannot comment on that number, but what I do know at this time, which is quite early in the fiscal year, is that current account deficit might be higher than it was last year. Oil prices, we talked about it just now, there is uncertainty and they might firm up even further. Other commodity prices also might remain firm for all the reasons that we discussed. Whether we import or not, a lot of commodities in India are import parity priced, so there will be an impact on that. On the export front, I hope that we can maintain that buoyancy of 36-37%, but we do have to acknowledge the risk factors, which is that if there is slackening in global recovery, it would have an impact on the export demand, and we might lose some of the buoyancy we saw late last year. So we have to be aware of these factors, uncertainties on the external front. So current account deficit of 4%, I do not want to comment on a specific number, but we have to be prepared for a current account deficit higher than 2.5%, which was the outcome last year.
Sure. Now the government has indicated a net borrowing number in the current financial year of 3,43,000 crores. But given the way oil prices are going, do you expect that that number is going to be broken, that we are going to see the government actually borrow far more than that, and the resultant impact of that on interest rates? What do you expect?
It'll be inappropriate for me to comment on that. It's a decision that the government has to take. But certainly, if they raise the borrowing program, it will have an impact on liquidity, it will have an impact on yields, it will have an impact on interest rates, that all of us know. But on whether the government will actually raise the borrowing limit is a decision that the government has to take.
Sure. Now, on the issue of net interest margins, you've spoken in the past about the need for banks to actually reduce their NIMs and improve the quality and cost of delivery. Now, when we speak to banks, they do admit that the quality of credit is improving significantly. It's improved a lot over the last few years. But in the same vein, they maintain that they will maintain their NIMs, if not expand them. Doesn't this some way indicate that our cost of credit in India is still stubbornly high?
Certainly, the cost of credit is high, and we need to bring down interest rates in the economy for bringing down prices in the domestic economy and to make our producers more competitive internationally. The interest rate is an important determinant of competitiveness. So we need to bring them down. On the question of net interest margins, I have said, and the Reserve Bank senior officers have said, that banks must offer higher deposit rates to depositors and reduce the borrowing costs for borrowers so that they become more efficient. Not that they reduce their profit margin, but they reduce their operating costs and deliver low cost credit. So precisely, I'm paraphrasing in my own words what you've said, which is that banks must become more efficient in order to make this country more competitive.
On the issue of new bank guidelines, there was an indication that it would be out by the end of March. And when we spoke about a year back, you did mention that corporates should not in any manner expect that the RBI will soften its stand on the issue of new bank licenses. That somewhere seems to have changed. The indication we get is that the RBI has been forced at some level to accept that corporates are given licenses. What should we expect on that front?
I think forced is a wrong word. We have put out a discussion paper with a completely open mind. We put out the pros and cons of allowing corporates into the banking sector. We've got an enormous amount of feedback, both for and against that. We put out the gist of that response on our website. So we've been completely transparent and completely open-minded on this. And on what our final view might be, you will have to await the draft guidelines.
Sure, but is the RBI confident of regulating corporates that are given licenses?
Should we decide to allow corporates to come in, which is something that I cannot comment on at this point of time, our ability to regulate them will certainly be a criteria in deciding on that.
And lastly, Governor, your term expires in just slightly over 4 months from now. Are you up for a second term if you were offered it?
That's for the government to decide, but I'm completely agnostic about it.
All right, Governor. Thanks.
Many thanks, George. Thanks very much.